Let's talk a little bit about timing on that. There is a camp of allocators who feel we're not quite out of the woods yet. They're expecting some continued defaults throughout the rest of the year as credit becomes, or at least liquidity becomes an issue, especially in emerging markets. So how does your team look at that angle? Do you agree with it, or do you feel we've mostly seen the bottom?
No, I would tend to agree with that. And most of the sell-side views or strategist views are in sync with that as well. So default rate projections for this year and next year are creeping higher. In Asia, people have moved up from 4% to like 10%, mostly because of the China property side. In the US side, high yield is looking shaky. The impact of higher rates has not fed through to the corporate balance sheets yet. So because a lot of the borrowings were like 2 or 3 year durations. Now when companies are refinancing those, they have to pay at the higher rates. And of course, that's feeding to a higher interest cost, so the P&L is getting affected. Interest coverage is lower. So that's increasing the default expectations for US market as well. So it's been a big focus area for us. We are actively investigating that for likelihood of defaults and putting on short trades in that space. Going into next year, all the CCC rated or CCC rated names in the US, there'll be a very high default rate there. So we are increasing our positioning in shorting those weaker names.
I was about to ask if the consensus and more importantly, the view becomes, I wouldn't say obvious, but clear. Does this make your job easier in deciding how much the fund should be positioning itself for the short book? And if that is the case, what are your plans there?
So ultimately, our view is that recession will come. Now, people have a lot of different types of views. Recession is not likely to come. It'll be slow, small recession, shallow recession. But what we are seeing is that if you look at some of the leading indicators of the economies, both developed market and emerging market, there's spots of weakness. Look at chemical prices, or demand for chemicals, freight indices for trade flows. A lot of them are going downwards. So while the expectations might be pushed back for recession, maybe first quarter, second quarter, it will come. That's our view. Maybe it might be third quarter of next year or fourth quarter, but that's likely to happen. And one of the reasons that will trigger the recession is also the job side. Right? People are saying, jobs in the US are still plentiful, unemployment is low, but you see all these CCC rated weaker companies which will default, and then they'll have to kind of close down. And each of them has 10,000 employees or 20,000 employees. So those jobs will be lost. That's what will trigger the recession. And it has always happened in the past. Some people saying, this time is different because they want to justify why the stock market is doing well. This time is different, but we disagree. It's always happens. When the Fed has raised rates in the last, if you look at 7-8 decades of history, if the Fed has raised rates at this pace, recession has always come. So we expect that to happen.
So on that point about US weakness, which naturally is going to percolate, I wouldn't call it contagion, but percolate into other emerging markets as well globally. We're seeing this sudden unexpected bump driven by AI and how that's helping certain sectors, both in semiconductors and in high tech, kind of resist some of this pressure that we're seeing in the market. Roosters will eventually come home to roost. When you look at weakness in other industries, we talk about short ideas. What industries do you think would be most susceptible to a recessionary environment?
Yeah, so the tech sector in general has been mostly equity financed. So the leverage in all of these large tech companies, or even mid-sized tech companies, is not that high. So we are credit investors, so that's less of a focus for us anyway. The rest of the sectors in the recession will be weak, like consumer sector, because you'll have job losses. So consumer-focused companies will be down. Retail sector, retail sales will eventually go down because people will buy less of the discretionary spending. Industrials, where end demand finally kind of converges, industrials and chemicals, those sectors will be down as well. We're looking at the telecom and cable and media space in the US. That's going to be weak as well. There's a lot of players. It's over-competitive. Cable as a delivery for entertainment has reduced as well in terms of attractiveness of product, delivery mechanism, speeds. So a lot of people are just moving to fiber and then Wi-Fi or 5G based connections. Because historically, there's some very large companies in the US that have been in that space. They're like 10 times leveraged, just about paying interest from cash flow. So those are the companies that will definitely struggle to survive.
So we might as well touch on the long book while we're here. Any optimistic sectors that you feel are worth keeping some exposure in, or are we looking full bore short for the next 2 years?
The long side, I feel initially as rates stabilize finally, eventually once the Fed is done with raising rates and maybe the recession likelihood looks more possible, there will be a spread widening. So the Fed cuts rates, the yield on corporate bonds will not immediately come down. So that's something we have to wait for. Once the spread widens to a fairly attractive level, we think the investment grade space, or better quality companies, the survivors, there will be a long opportunity. And that will also happen. The smaller companies will be weeded out, the bigger companies will get market share, and then they will do well. So that's what we are expecting, that investment grade space in the US or elsewhere will do well. There's also pockets of investment grade in Asia that are still relatively attractive where we have a long position. So for example, Indonesian quasi-sovereigns and related companies like Freeport, Indonesia, or some utilities in Indonesia that have very good contracts. There's some port operators in Australia that have very steady investment grade type cash flows. So those spreads are relatively wide now, and they might get even wider if recession comes. That's where we will focus on the long side. The third side is the AT1 space, which has been volatile. It's a high beta area. As of now, we think it's rallied quite a bit from the lows of March. We might take some profit off or let some of the calls that are getting called mature and then not replace that. But that's another area that provides opportunities time to time. For now, there's still relative value in credit in the AT1 space as well on the long side.
When we talk about credit in Asia, one of the themes that we see coming up is a greater resilience, or at least there seems to be a bias for credit strategies that are pan-Europe over pan-Asia. But I'm seeing a little bit of pushback in the sense that Asian borrowers are a little bit more comfortable with higher rate environments and therefore might have a stronger and more sustainable outlook. How do you feel about that? And does this play into your thesis for some of the larger Asian markets like Indonesia and Australia that you mentioned?
Yes, I think you're right. The European side has seen such low rates historically over the last 5-7 years that they're kind of used to paying a lower interest rate, whereas corresponding local rates in Asia have been pretty high. Even the dollar rates for a lot of borrowers, the corporate side has been fairly high. So they're used to seeing that rate, which is why the average leverage levels in Asia are also lower for the good quality IG names or even the mid-tier BB type names. So in a recession time or when Europe has struggles, the Asian investment grade good quality will outperform. So I agree with that. So we have to kind of keep our eye out for those type of opportunities.
So in Asia, you mentioned Indonesia, Australia. Other parts of Asia you mentioned before, relatively smaller markets for credit. But are there any pockets of interest for your team?
The rest of the markets are not that interesting. For example, Korea has a lot of the sovereigns which trade relatively tight to the sovereign and in absolute spread levels as well. Japan has a lot of issuance in the recent times from bank paper, from subordinated capital. Some of the Japan lifers have done deals which look interesting. So that's one area which we could consider. Taiwan does not have much issuance. Rest of Southeast Asia does not have that much issuance. China is, of course, remains the biggest investment grade market still in Asia. But a lot of the investment grade names in China are state-linked. So they are the usual Sinopex or the large central SASAC-owned companies, where people look at it again on a spread over sovereign basis, and they're still relatively tight. You get 6 points over the sovereign or 50 basis points over the sovereign. We find that as safe carry for those investors who are just focused on Asia and they have to buy Asian investment grade. For them, it's a good place to park their money. For us, because we look at capital upside as well, is it going to move? Is the price going to move? We find that less interesting because the spreads are already at fairly tight levels for the safer SOE-linked Chinese names.
That's interesting because China, at least from the credit side, you'd had big topic this week is obviously not just the default, but the bankruptcy of one of the largest property developers in the country. What's your view on what's happening in China right now? I mean, CB aside, how are you communicating with investors about where you stand with China? You feel that it still has some time to work itself out, but what kind of indicators are you looking for you to return?
It's a tough market. The economy has been weak. So while people are still expecting 4% growth and those projections are coming down, the trend is negative. So the confidence level in China among consumers, the property sector, basically sales have collapsed in most of the cities, including tier 2 cities now. So that's a tough spot. How it will pan out and what our view is on that sector, I think it's in a secular change mode. So the government has said that they don't want the leverage level to continue in both the corporate side as well as on personal level. People were buying houses for speculation, which from a long-term perspective, I can see why the government doesn't want that to keep going up, because ultimately then that might become an even bigger bubble and that will cause even bigger pain. So they're taking the pain now to change the whole business model of the property sector. Of course, in this process, the existing players will suffer. A lot of them will default. The biggest property developer you mentioned, they are focused on tier 3 and 4 cities. That is the weakest link. And they are also affected by demographics. So China population is now tapered off and now reducing. Once you have that, then the natural demand for property also tends to be lower. So it's not only that the demand is less, but it's also people's expectation of prices, because the marginal extra demand bumps up the price. But the marginal less demand now because of population will actually kill the price or price expectations. So in terms of sales, we don't see that recovering for the next many months, maybe a few quarters as well. Will the confidence come back? Maybe in tier 1 and 2 cities, which will have more, hukou reform or policy reform. The economies are still doing okay. Tier 3 and 4 cities, I think that's in a secular decline. So those companies which are focused on those sectors will have a tough time, including this biggest company. So the whole business model of the sector will change. That's what the government wants as well. More money than savings will be directed towards more growth sectors, which again, it's a government policy where you want savings to be directed to more value-add segments of the economy, right? So like tech sector or chip development or design. So savings of people which were just being parked in property now, eventually will be pushed towards equity financing for some of the high growth sectors. That will enable the country to move up the value chain. So I think that's the grand plan. Of course, in the process, in the interim, you will have certain wobbles in certain sectors. It's part of the game. So I think longer term, there is still an optimistic story in China. People's education level is high. There's a lot of graduates who are looking for work. Technology side, they're leading with innovation. So that high growth technology sector will definitely recover. The old school infrastructure, cement, construction areas will taper off. So that's how we will kind of position ourselves as well.
I guess the open-ended question that every investor will always ask you is about rates, where we're going, more importantly, timing. You touched a little bit on it when we talked about recession earlier, but why don't you walk us through your framework and we'll go from there.
Sure. So the US Fed has this dual objective, right? So maintain the employment levels and then maintain inflation at a moderate level. Those are kind of contradictory objectives if you think about it, right? You cannot have one or the other diverging. So right now, with inflation still relatively high, they are being forced to keep raising rates until they see a moderation in the inflation. Of course, because of the base effect of last year's sharp spurt, come the fourth quarter, that base effect will kick in and you'll see a moderation in inflation. But the job side is also another side they look at. Job growth has been fairly okay. Unemployment levels are low. Wage growth has been also okay, although the pace of wage increases has slowed down a bit. So in some sense, they are also looking at all these other positive indicators and saying the economy is running too hot. So the expectations of rate hikes have again come back. So there's people expecting one more rate hike. We think there is some possibility of that. But after that, I feel the base effect will be even stronger going into first quarter of next year. And then one of the key drivers being housing costs in the US. That has definitely tapered off in the last 6 months or so. So that will definitely affect the inflation going into first quarter. And once that happens, then the probability of hikes reduces. When will they start cutting is the next question, right? When will recession come in? Will they cut? When will they cut? That is still an open-ended question. People are struggling with timing that. Some expectations are there that they will start cutting March next year or April next year. I find that to be too optimistic. Whether recession will come in by March next year, I'm not sure. Slowdown might happen, so growth rates will slow down. If a lot of bankruptcies happen, like we discussed, then they might be forced to cut rates sooner. I think that might happen towards the middle of next year. As we discussed, I feel recession has to happen. Whether it happens second quarter, or third quarter, or fourth quarter, I don't know. So rates will eventually come down, maybe at a later time. And that's where the market is moving as well in that view. So maybe one more rate hike, possibly. No further rate hikes after that. And then rate cuts maybe in the middle part of next year or later. Now, then the short rates affect the longer rates. Now, people's view on 10-year rates or 5 years or 30 years. A lot of bond portfolio managers recently were saying we should go long duration. So a lot of people switch to longer duration bonds like 10 years or 30 years or longer duration corporate bonds, which are trading now like in the 50s because they were issued with a lower coupon. And that can provide them the duration benefit once rates tighten. But that's subject to how the curve evolves, right? So right now the curve is inverted. 2s10s is inverted by about 65 basis points. How will that evolve? So will recession be so steep or deep that Fed will cut rates aggressively, and how that will impact the 10-year, we don't know. So we feel that it will be less inverted at that point of time, but how much will the 10-year move? We don't know. It will obviously come down, but maybe, of course, much less than what the 2-year comes down. So in terms of hedging our IG investment grade positions, the way we look at it is, recently we have been also in the kind of longer duration camp. So we have reduced some of the hedges on our investment grade portfolio. We will consider reducing more once we feel that the rates have finally peaked, and that time we also take a duration view at that point of time. People were running ahead of the market and kind of trying to position before that, so it's gotten delayed, but eventually it will happen, and that's the time when we will also consider going longer duration.
Yeah, the market seems to be impatient to have it work, have the rates come down and worked out, but Fed doesn't seem to be having it, at least for the time being.
Yeah, you see a lot of these data analysis now, given you have technology to crunch numbers from the past, and you have all kinds of funky analysis about what happens 6 months after the Fed stops cutting rates, what happens 9 months after, 12 months, what happens before that. So people have used all this extra information to position ahead, saying everyone is in the same camp. Oh, market prices ahead of the actual event. But because of that, people are pricing even ahead of the ahead, Yeah. So it's getting too early. And that's timing is hurting now, of course, given how rates are moving.
Well, that's why we're seeing the whiplash effect now, and
Yes.
market in every asset class swing from one end to the other.
Yeah, so people got too long duration and positioned too much there, and now given what's happened last couple of weeks, rates moving up even higher, people are forced to kind of reevaluate that view. Were we too early in that view, and maybe take off some hedges? So people are changing that over positioning, So that long duration was overcrowded, is getting less overcrowded now. Of course, that helps from a technical perspective as well. The technical is another factor which we have to keep in mind. So there's both demand side and supply side. So the Fed, after the debt ceiling limit was removed, they have issued a lot of long duration bonds and medium duration bonds. So from a supply perspective, that has affected the technicals on the rates. The same side, on demand side, they have been cutting their balance sheet. So quantitative tightening continues. After the kind of relaxation in March, when they added some liquidity for addressing this SVB crisis, since then, the QT has continued.
Yeah.
So both the demand side and supply side technicals are against rates in the short term. So that's one more factor that's affecting the rates market we are keeping a watch on.
Do you want to touch on Europe? Europe is a touch and go type of environment. We're seeing some, you touched on SocGen, Credit Suisse as well. These are names that have been tricky to deal with in the past, but with the war still ongoing and supply chain disruption still getting worked out, and geopolitics still front page in that region of the world, is this an area that your team would feel comfortable?
Yeah, so look at the results from the banks. They have been surprisingly decent.
Yeah.
So credit costs have been very moderate for all the big banks. You look at whether it's the BNP or the SocGen, ING Bank, the British banks, even Deutsche Bank. Credit costs have been pretty moderate. So the impact of higher rates hasn't fed through into Europe yet. Of course, there are pockets of weakness. As I said, chemicals is an area of weakness. Trading is an area of weakness. China-related companies which export a lot to China, they are seeing some slowdown in demand. So there will be pockets of weakness, but the banks we feel are largely well capitalized already. Some of the banks have restarted stock buybacks, increased their dividends. So that's a sign of confidence that their capital is still very strong. So we are not very worried on the bank capital side. The war, the geopolitics, that's still a point of volatility. That's still not settled. It doesn't look like it's going to get settled in the short term. Related sectors like agriculture, trading, shipping, gas, energy, that's seeing volatility. Gas prices have gone up and down quite a bit in the last couple of days and weeks. So those sectors we are keeping away from because there are event risks in those sectors. Suddenly something happens, something blows up. We try to be cautious with those sectors.